You're staring at your portfolio on December 26th. Silver closed Christmas at $71.94 per ounce. 149% gain for the year. Your hands are shaking, not because of what happened, but because of what's about to happen. Because right now, at this exact moment, every major market maker, every institutional trading desk, every liquidity provider who keeps the silver market functioning just walked away from their terminals. They're on vacation. They'll be back. January 6th. That's 10 days. 10 full trading days where the fifth largest commodity futures market in the world is operating on skeleton crews and automated systems. And sitting right there in the middle of this liquidity blackout are 145,000 open futures contracts representing 725 million ounces of physical silver worth $52 billion. This is the Ghost Week liquidity trap, and it's already sprung. My name is Alex, and I've spent the last 8 years analyzing commodity market microstructure, which is a fancy way of saying I study what happens when there aren't enough buyers to match the sellers, or enough sellers to match the buyers. And what I'm about to show you is the most dangerous market setup I've seen since nickel went vertical on the London Metal Exchange in 2022 and bankrupted a $7 billion trading firm in 48 hours. If you're trading silver, holding silver mining stocks, or trying to figure out whether $72 is the top or just the beginning, make sure you hit that subscribe button because the mechanics I'm breaking down in the next 15 minutes will determine whether you capture the next leg or get destroyed by volatility you didn't see coming. Here's what everyone's talking about right now. They're saying silver's overbought. They're pointing to the RSI. They're citing historical resistance levels. They're calling this a bubble because it went up too fast. And all of that analysis is built on one fundamental assumption, that markets behave normally when liquidity is normal. That's the trap right there. Because we're not in a normal market anymore. We're in a structural deficit market operating under Ghost Week conditions with institutional positioning that's more lopsided than at any point in the last decade. Let me paint you the picture nobody's showing you. Trading volume in precious metals dropped 70% or more during the week between Christmas and New Year's. That's not speculation, that's historical data from CME Group going back 20 years. But here's what makes this year different. The open interest, meaning the total number of contracts that haven't been closed or delivered, that number hasn't dropped. March 2026, contracts, ticker symbol SIH26, are sitting at elevated levels because industrial buyers who normally would have rolled or closed their positions before the holidays couldn't. Why? Because the physical market is so tight right now that closing a futures position means finding actual metal to buy, and there isn't enough available at current prices. So instead, they're frozen. 145,000 contracts sitting in limbo while the people who normally provide the other side of those trades are eating leftover turkey and ignoring their phones. Now let me show you what's happening underneath that. Silver has been in a supply deficit for 7 consecutive years. Not quarters. Not months. 7 full years. The Silver Institute's World Silver Survey documented a cumulative shortfall of 678 million ounces since 2018. 2024 alone showed a deficit of 148.9 million ounces. Global mine production has been essentially flat at 813 million ounces for the last 5 years, while industrial demand hit 680.5 million ounces and keeps climbing. This isn't a temporary imbalance. This is a structural break in the supply chain that can't be fixed quickly because silver mines take 6.5 years on average to go from discovery to production, according to S&P Global Market Intelligence. But here's where it gets genuinely dangerous. Solar panel manufacturing is consuming over 200 million ounces of silver annually right now. And the technology shift happening in solar is making the problem exponentially worse. The industry's moving from PERC cell technology to TOPCon cells because they're more efficient. Great for solar output. Catastrophic for silver demand because TOPCon cells require 50% more silver per panel. The International Energy Agency is projecting solar alone will consume 450 million ounces annually by 2030. That's more than half of current global production being absorbed by a single industrial application that absolutely cannot substitute another material because silver's unique combination of electrical conductivity, thermal conductivity, and reflectivity is what makes the technology work. Add automotive to that. Every electric vehicle uses between 1 and 2 ounces of silver depending on the model. Global EV production hit 14 million units in 2024. That's another 14 to 28 million ounces of inelastic industrial demand. Medicine, electronics, photovoltaics, 5G infrastructure. The U.S. Geological Survey designated silver a critical mineral in 2025, specifically because industrial applications have made it strategically important and supply is concentrated in politically unstable regions. This matters because it means silver isn't just a precious metal anymore. It's an industrial commodity with precious metal pricing dynamics, which creates the exact conditions for violent price discovery when liquidity disappears. Now we're going to talk about what happens when all of this converges during Ghost Week. But first, you need to understand the positioning that was already in place before everyone went on vacation. The CFTC commitments of traders reports from mid-December showed commercial traders, that's the banks and market makers who normally provide liquidity, holding their largest net short position in 18 months. They were short because they had been selling to hedge industrial demand and to meet investment inflows. Under normal conditions, they'd manage those positions throughout the day, adjusting based on order flow, keeping spreads tight. But it's not normal conditions right now. The people who manage those positions aren't at their desks. The systems are automated, and automated systems don't adjust to changing fundamentals. They execute based on predetermined rules. So here's what's been building since December 26th. Industrial buyers who needed to lock in silver for Q1 production couldn't execute their normal spot market purchases because physical premiums went completely unhinged. I'm talking 12 to 18% premiums over spot for 1,000-ounce bars in some markets. That's not normal. Normal is 2 to 4%. So instead of buying physical, they're being forced into futures markets to secure supply. But futures markets during Ghost Week don't have the depth to absorb large orders without moving price. Every large industrial buy order is hitting thin order books and pushing price up 3, 4, 5% in minutes. And every time price jumps like that, it triggers stop losses on the commercial short positions that are being managed by algorithms, not humans. Those algorithms cover by buying, which pushes price higher, which triggers more stops. This is the exact mechanism that took nickel from $29,000 a ton to over $100,000 a ton in 2 days back in March 2022. It wasn't demand, it wasn't supply. It was a liquidity vacuum meeting forced covering in a structurally tight market. The London Metal Exchange had to halt trading and cancel trades. With silver, there's no circuit breaker that's wide enough. CME has limits, but they're plus or minus $7 for the nearby contract. Silver moved $4 in 3 trading sessions last week. We're already halfway to limit up and the real pressure hasn't even started yet. UBS put out a note to clients on December 23rd calling recent precious metals price action unhinged and warning that volatility metrics were signaling unstable conditions. Kitco Metals, one of the most conservative analysts in the space, published a $75 price target for Q1 2026 based purely on technical breakouts and momentum. Neither of those calls are accounting for what happens when liquidity returns on January 6th and every deferred industrial purchase, every margin call, every momentum algorithm hits the market simultaneously after 10 days of thin trading. That's not a prediction. That's basic market mechanics. When you remove liquidity and freeze positions, the pressure builds. And when liquidity returns, that pressure releases. The only question is how violent the release is. Now let me show you why this can't resolve to the downside. Normally, when a commodity gets too expensive, 3 things happen. Producers increase supply, consumers reduce demand, substitutes enter the market. None of those mechanisms work with silver right now. Producers can't increase supply because there are no large silver, only mines ready to come online. Most silver is mined as a byproduct of copper, lead, and zinc operations. You can't just dig more silver without copper prices justifying expanded operations. And even if copper prices cooperated, the timeline from approval to production is measured in years, not months. So supply is fixed. Consumers can reduce demand in theory. In practice, industrial consumers are locked in. Solar manufacturers can't reduce silver content in panels because the efficiency drops, and they're competing in a market where efficiency determines whether they get contracts. Automotive manufacturers can't eliminate silver from EV drivetrains without redesigning entire platforms, which takes 4 to 5 years and billions in development costs. Medical device manufacturers can't substitute because silver's antimicrobial properties are unique. Industrial demand is what economists call perfectly inelastic at this point. Price doesn't reduce consumption because consumption isn't optional, and substitutes don't exist at scale. Copper is a decent electrical conductor. It's not good enough for solar applications where you need maximum efficiency and minimal space. Aluminum is lighter. It's not conductive enough. Gold is more conductive. It's also 6 times more expensive and even rarer. There's no material that matches silver's combination of properties at any price point below current silver prices, which means the market can't rebalance through substitution. So you have inelastic demand, fixed supply, and no substitutes meeting a liquidity crisis during Ghost Week. The only variable that can adjust is price, and price adjusts through gaps, not smooth increases. Gaps. Because in thin markets, the next buyer willing to pay might be 5% higher than the last trade. And if that buyer is an industrial manufacturer who needs the metal, or they shut down a production line worth millions per day, they'll pay the 5%. And once that trade prints, it becomes the new reference price. And algorithms see that price and adjust their orders. And suddenly 72 becomes 75, becomes 80. Here's what nobody's prepared for. When markets reopen with full liquidity on January 6th, there will have been 10 days of price discovery happening in what FX leaders called the thinnest institutional participation of the calendar year. Every price that printed during that period is suspect. It's not validated by normal order flow. It's not tested by normal depth. So when institutional desks come back, the first thing they'll do is test whether those prices are real. They'll probe the market. And if the market doesn't have sellers at those levels, which it won't because physical holders saw what happened during Ghost Week and adjusted their offers higher, then institutions have 2 choices. They can wait for sellers to appear, or they can chase. And if there are industrial buyers lined up behind them with actual production needs, they can't wait. They have to chase. This is where the psychology shifts from investment to panic. When price gaps 5 or 10% in a day, investment buyers pause. They wait for a pullback. But industrial buyers can't pause. They have contractual obligations. They have production schedules. They have clients. So they buy regardless of price. And their buying creates a visual on the charts that looks like absolute mania, which attracts momentum traders, which creates more buying pressure, which forces out more commercial shorts, which loops back on itself. The most dangerous part of this entire setup isn't the price level. It's the feedback loop. Every component of this market structure reinforces every other component. Tight physical supply makes futures positioning more critical. Thin Ghost Week liquidity makes positioning adjustments impossible. Structural deficits make price elastic to any new demand. Inelastic industrial consumption means someone must buy at any price. Commercial shorts managed by algorithms means covering happens mechanically, not strategically. It's a perfectly constructed trap where every normal market mechanism that would prevent runaway prices has been disabled. Now I'm going to tell you something that's going to sound extreme, but I need you to hear it. The silver market is currently operating in the same regime that oil was in during the 2008 spike and nickel was in during the 2022 squeeze. In both cases, futures markets disconnected from physical markets because the paper market assumed supply was elastic and the physical market knew it wasn't. In both cases, that disconnect resolved violently and quickly when forced buyers entered the market. Oil went from $90 to $147 in 6 months. Nickel doubled in 2 days. Silver's starting from a higher relative valuation than either of those. It has a smaller market, and it has structural deficits those markets didn't have. I'm not saying silver goes to $150 next week. I'm saying the conditions exist for silver to gap in ways that seem impossible until they happen. Because the market isn't pricing in Ghost Week mechanics. It's not pricing in the solar demand bomb that's already in motion. It's not pricing in how illiquid this market becomes when dealers step away. And most critically, it's not pricing in the binary nature of the supply response. Either supply increases, which takes years, or price keeps rising until demand destruction occurs, which requires prices so high that industrial applications become economically unviable. And before demand destruction happens, you get the mother of all squeezes, as everyone who needs metal realizes simultaneously that there isn't enough. If you've made it this far, you're already thinking 3 steps ahead of 90% of people watching silver right now. But don't stop now, because what comes next is how you actually position for this without getting destroyed by the volatility. First, understand that Ghost Week liquidity means normal technical analysis doesn't work. Support and resistance levels are meaningless when there isn't depth at those levels. Trend lines are irrelevant when price gaps overnight. Your entire framework has to shift from predicting price to managing position. That means if you're long, you're thinking about what happens when price gaps $5 in your favor overnight and then reverses $3 at the open because profit taking hits thin liquidity. It means if you're short, you're thinking about limit up days where you can't cover at any price you're willing to pay. Second, the March 2026 contract is where the pressure is concentrated. That's where industrial buyers are positioned. That's where commercial shorts are stuck. When that contract starts moving, it'll move harder than spot because futures are leveraged exposure to the same dynamics. But leverage cuts both ways. A 5% move in spot is a 20% move in your account if you're on 5-to-1 leverage, which sounds great until it goes against you. Third, physical premiums are telling you something futures prices aren't. When you see 12 to 18% premiums on bars and coins, that's not speculation. That's real buyers paying real money because they value possession over paper promises. Physical markets lead futures, markets in tight supply situations. Always. If physical premiums are rising while futures are consolidating, futures are mispriced. They'll catch up. But the catch-up happens in gaps, not smooth adjustments. Fourth, mining stocks are not the same as metal. This is critical. Mining stocks are leveraged plays on metal prices, but they're also operational businesses with costs, political risks, and execution risks. When silver spikes, miners initially follow, but if the spike is fast enough, it triggers concerns about nationalization, windfall taxes, and contract renegotiations that actually make some miners less valuable even as metal prices rise. If you're playing this through equities, you need to know which companies have locked-in costs, which have streaming agreements, and which have political risk exposure. Fifth, the timeline matters more than the target. I can't tell you if silver tops at 85 or 105 or 120. Nobody can. But I can tell you that Ghost Week liquidity ends January 6th. Industrial Q1 purchasing accelerates in January. Solar manufacturing ramps in February ahead of spring installation season. Automotive production cycles restart after holiday shutdowns in early January. All of that demand hits the market in a 6-week window starting now. That's not speculation. That's the industrial calendar. Which means if this squeeze happens, it happens in Q1, not Q3, not next year, the next 60 days. The real magic happens in your brain when you realize this isn't about whether silver goes up. It's about whether you're positioned for a market that no longer behaves predictably. Most people approach commodities like they're trading stocks. They buy dips, they sell rallies. They trust that liquidity will always be there when they need it. But commodity markets aren't equity markets. They're physical markets with paper derivatives layered on top. And when the physical market gets tight enough, the paper market breaks. It doesn't bend, it breaks. Positions get liquidated at prices that don't make sense. Margin calls forced selling at the worst possible time. Exchanges change rules overnight. Here's the hard truth that might sting a little. If you're trading silver right now based on chart patterns and RSI readings, you're bringing a knife to a gunfight. Technical analysis works in liquid markets with normal behavior. This isn't that. This is a structural squeeze meeting a liquidity vacuum during the thinnest trading period of the year with industrial buyers who have to purchase regardless of price. Your moving averages don't account for that. Your Fibonacci retracements don't account for that. Your gut feeling doesn't account for that. The miners, the manufacturers, the central banks, they're not looking at your charts. They're looking at production schedules and delivery timelines and contractual obligations. And when their systems say they need 1,000 ounces by February 15th or a production line stops, they buy at 72, at 82, at 92. Because the cost of not having the metal is higher than any price they'll pay for it. That's what inelastic demand means in practice. Now let me tie all of this together, because when you see how these pieces connect, the entire market structure becomes clear. You have 7 years of accumulated supply deficits creating a structural shortage. You have solar demand requiring 50% more metal per panel just as installation rates accelerate. You have automotive electrification adding millions of ounces of new demand. You have mine production frozen by development timelines measured in years. You have ghost weak liquidity removing the market makers who normally smooth price action. You have commercial shorts stuck in positions they can't manage with skeleton crews. You have industrial buyers who must purchase regardless of price. And you have 145,000 futures contracts representing $52 billion of notional exposure sitting in the middle of all of this waiting for January 6th when everyone comes back and tries to adjust their positions simultaneously. That's not a market. That's a powder keg. And the fuse is already lit. The only question is whether you're positioned for the explosion or standing too close when it happens. You're no longer guessing whether silver is expensive at $72. You're calculating whether the market structure supports a violent repricing event when liquidity returns. You're no longer trading technicals, you're trading mechanics. The mechanics of supply and demand meeting liquidity and positioning in a market that's too small to absorb the pressure building underneath it. The mechanics of industrial buyers who can't wait meeting commercial sellers who can't deliver. The mechanics of futures contracts that must settle meeting physical metal that doesn't exist at prices anyone's willing to accept. This isn't your grandfather's silver market where you bought coins and waited 10 years. This is a market in transition from precious metal to strategic industrial commodity, and that transition happens in violent repricings, not smooth adjustments. Because markets don't gradually acknowledge their math was 15% off, they gap. They lock limit, they break correlations, they force recalculations, and everyone who wasn't paying attention gets taught an expensive lesson about the difference between price and value. Your future self 10 years from now will look back at December 2025 silver prices the same way people look back at $20 oil in 2008 or $300 Bitcoin in 2015. Not as expensive, as obvious in retrospect, because the math was always there. The supply deficit was documented. The solar demand was projected. The mine development timelines were published. The ghost week liquidity patterns were historical data. Everything you needed to know was available. The only question was whether you were willing to act on information that felt uncomfortable because the price had already moved so far. The people who capture the next leg aren't the ones with the best charts. They're the ones who understand the market structure better than the market prices it. They're the ones who see that 145,000 contracts meeting skeleton crew liquidity during the highest industrial demand period of the year creates a binary outcome. Either price stays here and industrial buyers can't secure metal and production lines stop, or price gaps until supply appears. And since supply can't appear because mines take years to build, price has to keep moving until someone blinks. Your job is to figure out who blinks first. The industrial buyer who needs the metal? Or the futures trader who's over-leveraged and can't hold through volatility? I'll give you a hint. The industrial buyer has a production schedule and a client contract and a CFO breathing down their neck about raw material availability. The futures trader has a margin call and a spouse asking why the account is down 30%. Who do you think holds longer? That's the game. That's the math. That's the reality. And it starts tomorrow when markets open after Christmas and liquidity is 70% thinner than normal and 145,000 contracts are frozen in place and industrial buyers start realizing they can't wait anymore. The squeeze doesn't start when everyone's watching. It starts when nobody's paying attention. And by the time the analysis catches up, the move is already over.